Morning, everyone, and welcome to this morning's build session on CIP strategies, or CIP easy as 1, 2, 3, I think it went out as. So just by way of introductions and how the session is going to be structured. So my name, followed by my photo, is Alistair Wilson, and I'm the investment specialist here at the Verve Group. So my day-to-day job is sitting down with advice firms, and then between them and our internal compliance department, we will sit and discuss prod. And then off the back of prod discussions and client segmentation and business processes, then we will look to build out different firms' platforms, product solutions, and then off the back of those, or like in synergy with each other, we will then work out suitable investment strategies that they are able to recommend to their client banks. So today is going to be all about CIPs. So my sessions are going to be on navigating the minefield. So just basically looking at what investment structures are out there, what each type of investment structure means, which clients they might be suitable for, whether you need to include them on a CIP, and then a little bit of a wrap up at the end on consumer duty. And then also just a little bit about what a CIP actually is, what it's for, and how to implement them well. So that'll be me all wrapped up at about 10:15. Then we'll have a 15-minute break before we are then joined by Lee from PIMCO, and then who will be discussing the future of bonds as assets in a diversified portfolio. And then following that, from 11:15 till the session closed at midday, we will then have Mandeep and Ben from BlackRock talking about the 60/40 portfolio. And then there's also a little bit of discussion on multi-asset funds and different strategies that BlackRock can use within, or they use within their multi-asset funds. Oh, sorry. Sorry, Mark. Is the speakers okay on what you're listening through? And can everybody else in the chat hear okay? Yeah, I was going to say, Mark, I think we did a little sound check at the start, and like everybody else in the group seems to be able to hear okay. So if you can double check the speakers on your computer, again, as Jasmine mentioned, just log out, log back in, and see if that helps. Okay, so I'll kick off with my own session. So the learning objectives by the end of what you or by the end of my session, so by 10:15, then you should be able to articulate the key differences between a number of core investment structures, and then also to be able to justify why these investment structures may or may not be suitable for different types of clients that you may or may not deal with, and whether you need to actually include them in a centralized proposition or not. And so if there's any questions throughout, then feel free to use the chat box. There's some bits where I've intentionally left out early in the presentation to include later on. So if you pop any questions as we go in the chat box, and then I'll do a little roundup at the end before we all go for a little break. Okay, doc. So first of all, I just wanted to kick off with what exactly a centralized investment proposition is. So there are firms out there that still don't have a CIP in place, or they just prefer to do bespoke research per client. So just by definition, a centralized investment proposition will actually negate the need to do individual research on per client basis. So a centralized investment proposition it's based off the segments identified as part of your prod assessment. So as part of prod, you should have identified common client needs within different segments within your business. So both in your existing client bank and in the target market going forward. So based on these common investment needs of different clients, then you should be able to centralize and group together certain banks, which basically means you don't have to do bespoke research for approval with every single file that you submit for compliance. So this is all carried out at a higher level, obviously, so there might be some outliers or some which don't quite fit. But again, with the CIP, there should always be room to or for those outliers to be accommodated. So carried out at a high level rather than case by case. And just another little note as well on CIP. So really, prod should be the very, very first step that you carry out in identifying target markets, identifying common investment needs. So again, prod's also much more encompassing than just the investment strategies. So you'll also need to consider the service levels that you offer to clients as a firm. And again, how the investment strategies will link to not just client needs, but then also your ability to provide the services that you want via certain investment styles and investment structures. So platform due diligence, we always find it's like a little bit of a chicken and egg scenario, but of course, a platform and your products have to be able to support the investment strategies you want, and vice versa. So it's always best to do them both at the same time, or at least keep revisiting one and the other. So often when it comes to fund ranges, when it comes to different portfolio services, then it can get a bit patchy where platforms are concerned. So sometimes it may end up with a bit of back and forth just as you reach a very good compromise that allows the or what you want to deliver to your clients to be delivered to your clients while still being effective from a client administration point of view and on a cost-effective platform or vehicle to provide the investments. So our view of Vert, or their view on this is ideally to prioritize investment strategy research, basically just because this is what will have much more of an impact on the end client. So it'll be much more visible, and it also needs to meet more of the client needs than just a platform, which again is generally more of like a facilitation tool. So that's more for an advisor benefit. But then of course a platform has to be able to deliver the proposition at a reasonable cost. So in the real world, it doesn't necessarily work out like that. But in an ideal world, investment strategies should ideally be prioritized first and foremost. So next on what is a CIP is why should a firm, or why should your firm implement a centralized investment proposition? So on the first point, we have efficiency within the firm. So instead of having to repeat research on a bespoke basis for every client that you onboard, for every suitability report, recommending investment switches, changes in risk profiles even, then it will all have to be done on a bespoke basis. Whereas if you have a centralized investment proposition on the file that's going to be considered for suitability or for compliance, then it just has to refer to the bank of research on file that you've conducted off the back of prod, and the centralized bank of research that you've done on your investment structures, your investment styles, investment providers, and why they are suitable for that bank of clients. So it should just be able to articulate this client falls into this bank of clients, and thus based on our CIP and prod research, we have determined that Y range of funds is the most suitable for their needs. So it basically just removes that need to go through the whole research note to add on a file as to why such and such investments are more suitable, and instead of doing like a whole of market analysis each time. So again, this obviously means less time spent on individual research, which in turn means more time you can spend discussing financial planning matters with your client, rather than sitting in FE looking at past performance and volatility figures and basically just getting bogged down in things that you might not have the time for, that you don't want to have the time for, and then just to revisit that proposition once every year. So linking to the above, suitability will also factor in. So if you have, so suitability and consistency are kind of one and the same as well. So these will all link together. So if you have a centralized approach within your firm to show that the whole wider market has been considered, and that you have narrowed down these ranges based on client need off the back of prod, then that means it's much less likely for different advisors within the firm or even within a network to go off and recommend their own things or get different results from from different research methodologies. And then that links into consistency and what's on everyone's mouth at the moment with consumer duty. So ensuring consistency means that even though there may be multiple advisors, even multiple administrators, if they're tasked with doing investment strategy research. So what a centralized approach will do is just bring in consistency to the business to make sure that advisor A and advisor B are reading off the same hymn book, and they are looking and considering at the same investment strategies, the similar platforms as well. And then that will go some way to ensuring consistent client outcomes within your firm. So that will basically sort of eliminate where, you know, one advisor might be recommending an MPS via a platform, and then another advisor may do their research process and then end up recommending, you know, a standalone pension with an internal portfolio. So there's two different approaches. So even though both of them are ultimately suitable, then it's just a client walking out with two different products, potentially two different charges, two different investment philosophies, investment styles. But having a centralized approach brings all of that consistency into one place. Okie doke, so that's the groundwork sorted. So if there's no questions thus far, we'll just move on to the investment structures themselves. So on DNA, we have a lot of discussions as part of prod with advisors who are just concerned with what a CIP should contain, what different investment structures mean, who they should, or which clients should go into which investment strategies, and then getting, you know, all kind of like confused and confuddled with what other firms are doing, what the FCA says, is it suitable, is it right, is it wrong, and things like that. So what we'll aim to do here is just go through some different investment structures, how each of them work, and typically what kind of firms or what firms are doing with those investment structures that we've gleaned from our experience in offering DNA over the last couple of years at Verve. So the first one are multi-asset funds. So all a multi-asset fund is so it's basically just as it does what it says on the tin. It's a single fund which includes exposure to different assets. So there's diversification built into a single fund. So historically, you might have had very focused investment funds, which should have been, you know, UK small cap equity, and it would be the job of a portfolio manager to bring all of those into one diversified portfolio, again with, you know, US small cap equity or emerging market mid caps and all sorts of getting bogged down in asset allocations and things like that. So with a multi-asset fund, all of that is taken care of within one simple structure, and so it's usually structured as an OIC. So pretty much every single multi-asset fund will have exposure to equities and bonds. So some, and again, so they're the two classic growth and more defensive assets. Again, historically, so I'm talking sweeping generalization here and not kind of like over the last year or two where bonds have also been very volatile. But again, as part of your CIP research, you may want to include other or exposure to other assets. So there's some multi-asset funds which will bring in property, it will bring in derivatives, exposure to commodities, cash. So there's no, you know, so there's no practical reason why some of these funds can't hold quite large sums of money. So even though it is only listed as one single line on a platform, there is so in some cases there's a highly diversified range of assets and geographies within there as well, so you can get a global exposure within a multi-asset fund, and again across different underlying assets. So even with some of these ranges, the top end, so the highest risk, will still have it will have a single asset exposure, but these are termed multi-index funds, but then they will track a range of global indices. So in theory, you're getting exposure. Also, so if it's an actively managed fund, then it will still track a huge range of different sub funds, which will provide a greater exposure to global equities, all in one neatly wrapped structure. So when it comes to multi-asset funds, they're typically taken on by advisors in ranges. So they will have a risk range of low to high, and there's typically about 5 funds. Some will offer 6, some will offer 7, and then they are all mapped to the mainstream risk profiling tools. So again, with multi-asset funds, so we've completed CIPs before where advisors have just wanted to recommend one single range, and just to make sure that the proposition across the full range of risk level or risk profiles is a strong proposition. Whereas other firms we've prepared, I guess, sort of like a patchwork. So for each risk level, we've looked at just the best single fund within that risk selection. So there's kind of like a mix match of a blend of providers that they're able to offer. So one of the key features or the key benefits of a multi-asset fund is that it's great for managing CGT. So because it only occupies one line of an investment statement, so on a platform statement, for instance, where you're looking at like a value update or you're looking at growth, then a single multi-asset fund has one purchase cost and one sale cost. So working out the growth on that one fund is very easy to calculate any potential capital gains tax liabilities. So if there's any clients with a fairly significant sum of money that's sitting outside an investment wrapper, so a tax advantaged wrapper. So if it's just in a general investment account, then it makes it very easy to calculate any potential capital gains tax liabilities and makes it easier to manage. So that's particularly the case as well with capital gains tax allowances. So the tax-free allowances being reduced this tax year, and it will be halved again next year. So there's going to be more and more clients falling into that trap of being liable for any capital gains in excess. So that's £6,000 this tax year, £3,000 next tax year. So even fairly modest investors might be caught out by that. And it might be handy to have some multi-asset funds available if you're one of the advisors that falls into having a number of clients with unwrapped assets. So another key benefit for a multi-asset fund is the low barrier to entry. So this is kind of setting the scene for some of the other investment structures we're going to discuss. So multi-asset funds, again, this is usually dictated by a platform, but it's easier for a platform to administer low contribution levels to a single multi-asset fund. So these may mean they're very accessible for new investors, so people just starting out on their accumulation journey, or those who have only just come into a little bit of money and just starting a new pension, for instance. Then the low barrier or the low contribution barrier to multi-asset funds. So sometimes it's about £25 a month, whereas other investment structures we'll look at further on in this presentation, there's quite a significant cost hurdle to overcome in terms of levels of minimum assets. So lastly, so there's only a single charge as well. So where it comes to other investment structures or multiple funds, then there may be lots of charges going around, and it's tricky to keep a tab on. So when it comes to like an annual review for a client, it's monitoring the weighted ongoing charge that they've been charged over the course of a year. But with the multi-asset fund, there's only one single charge to detail in suitability reports. So then it just makes that whole process nice and streamlined as well, particularly for some of the clients that you may be recommending these types of funds to. So you'll be wanting to keep that administration and report detail to a minimum if possible. So although this charge is a single charge, multi-asset funds can incorporate a number of investment styles and philosophies. So you can have active funds, you can have passive funds, you can have blended philosophies, you can have UK biases, you can have multi-asset funds which incorporate various levels or various shades of green with ESG, different ESG policies. So depending on how all of these are managed, so some funds are obviously a lot more active than others. So that not necessarily cheap remark comes from, so some actively managed multi-asset funds are very expensive, so they will often exceed 1%, maybe up to 1.5%. And I've even seen some actively managed multi-asset funds nudging 2% as their ongoing charges figure. So even then, so multi-asset funds, you can get them very cheap, but it's also important to keep an eye on that So even as some investment structures we'll look at further on, which are typically associated with higher net worth clients and higher ongoing fees, when you actually add together the fees from those propositions, it might be much more of a level playing field overall. So to summarize that section, do I have to include a multi-asset range in my CIP? So the answer is no, you don't have to. Nothing's mandated within a CIP. It's not like an FCA regulation that you have to have a CIP, but it just means that off the back of prod, it's very useful to implement one as well, just to be able to evidence consumer duty a little bit better. But there's some firms might not deal with clients that will require the use of a multi-asset fund. So typically, if you have a lot of clients with unwrapped investments, then it might be handy to have a range on hand just for capital gains tax mitigation. And as I mentioned, again, if you deal with a lot of younger clients who are just starting off accumulating, if you do a lot of family financial planning, where parents and grandparents are looking to make investments for their children or grandchildren, then having a multi-asset range is very useful because of those low cost barriers to entry or low minimum contributions. So it makes it very handy as well to keep an eye on them from a risk perspective as well, just to make it a bit more value for money for you as an advice firm. So to be able to offer a lower cost to the end client, then multi-asset funds can make the advice process a lot simpler. So another use case that we've seen a lot of multi-asset funds for within DNA is even if advice firms don't want to offer an ongoing proposition to clients using a multi-asset funds, a multi-asset fund range, then the very popular solutions, because they come in a range of risk profiles and they are managed by the fund provider to remain in line with those risk profiles, they are very popular for transactional advice. So where you don't want an ongoing relationship with these new starter clients, just because it's not worth your time or the clients won't be able to meet your minimum fee requirements, then a multi-asset fund that's risk managed or risk mapped is very handy just to be able to carry out transactional advice, plonk a client in that fund on a certain platform which they can manage themselves, and then just say, there you go, we'll see you in 5 years, 10 years maybe. Just keep up your contributions, and any further advice, then just get in touch. But we won't be having an annual face-to-face review. We won't be doing a full annual suitability review, because for the younger accumulators, which hopefully I'll still fall into, then an annual cash flow review or annual meeting, that's something that I would see very little value in for a client. So I wouldn't want to be paying, an awful lot of money to have those services when I don't need them. Okay, next one, next investment structure, MPSs. So MPSs are a little bit of a contentious issue in terms of value, or there's been rumblings amongst clients that we've been discussing with as whether they do provide a true value in comparison to a multi-asset fund. So what we'll discuss here is just what are the value of an MPS, what type of clients they're suitable for as well, and where you may want to consider. So one of the key things that we see when discussing with advice firms where they've got particularly clients with higher net worth, they don't want to put, a £1 million portfolio or even a £500,000 portfolio in one single multi-asset fund, because then when they provide a statement that they've got a very significant amount of money in one single fund, then it may be a little bit unnerving to the client, or it may have that appearance to lesser experienced investors that it's not diversified enough. So it just basically saves you the task of explaining to a client what a multi-asset fund is, how it's well diversified, how the assets under administration doesn't matter, how some multi-asset funds have billions of pounds in one single fund, but an MPS can appear more significant, can appear more reassuring, that there's a portfolio manager taking care of their funds, and then being able to see those rebalances, and that the fund or the portfolio manager is having an active role in monitoring that portfolio in regards to the markets, can provide significant reassurance to clients. Whereas a multi-asset fund, you won't get that kind of service from, and it's all a little bit opaque and wrapped up in a key investor information document. So next point. So with an MPS, multi-asset funds investment mandates tend to be quite broad. So providers of multi-asset funds will tend to cast a wide net to get as many client assets in there as possible. So it tries to be most things to most people, whereas an MPS, they're able to carve out specific niches when it comes to strategies. So at the moment, ESG, again, it's another hot topic. So there's some MPS providers that are very, very passionate about certain sustainability metrics, whether it's alignment with the Paris Agreement, whether it's cutting out fossil fuels, whether it's cutting out exposure to other kinds of potentially unsustainable factors. Then an MPS is able to carry out the research and dictate its own investment strategy or its own investment style. So beyond that as well, certain MPSs will also include different instruments. So it might include exposure to ETFs or investment trusts if that's a particular interest in the pursuit of outright long-term growth. And again, they can also blend different philosophies effectively. So small cap, mid cap, large cap funds, it can include specific sectors, and they will also have a bespoke asset allocation to work with as well, meaning that they're able to bring in different exposures to different niche sectors to be able to sell that to different client banks. So there are some considerations to look out for with taking on an MPS. So the first one is platform availability. So MPS is a little bit of a mixed bag when it comes to platform availability still. So your chosen MPS, so if you've done all your research, all your due diligence, you've settled on an MPS, and then you find out that your favorite platform doesn't support it. So there are ways of going about it. You can get in contact with the platforms, and if there's obviously sufficient assets for that particular portfolio managers to migrate across, then they may be able to help and facilitate it. But this is generally only for larger firms where they have a significant amount of assets that make it worthwhile for a platform to onboard. So for the rest, you're kind of stuck if you've got a perfect MPS strategy in your platforms that's not available via your chosen platform. So it is something to say when so when you are pulling together the due diligence, it's important to consider the platform availability as well as at the same time you constructing your MPS due diligence. So a minimum contribution, so unlike multi-asset funds and MPS, it's typically the platforms that will impose these minimum contributions just to keep that flow of money coming in. So most MPSs or platforms or MPSs will levy a minimum contribution of around £10,000 or £20,000, which again puts it out of reach of some of the new starter investors and some of the very young accumulators, unless they're kind of linked by some family portfolio linking via a platform. So another thing to consider is dealing costs. Again, this is, I suppose, platform dependent, that dealing costs will add. So as the MPS provider will buy and sell assets and rebalance portfolios and make fund switches, then there may be some underlying dealing costs that will be levied on the end client, just depending on how many rebalances and the size of those changes as well. So lastly, and perhaps the biggest consideration with an MPS, if you have clients with significant unwrapped investments, then in handing over responsibility of managing this portfolio of funds to an MPS provider, so they will use their discretionary permissions to buy and sell on behalf of the client, then because it's still an off-the-shelf solution, then there's no bespoke element to it. So when an MPS rebalances, it rebalances every single portfolio for every single client, regardless of tax situation or how much money's in there, just because it's an off-the-shelf solution. So it has to be all done at once to maintain compliance with their own performance records. So this will lead to problems when when MPSs are unwrapped, just because if there's a significant gain that's built up in one fund and then during a rebalance, which the client has no control over because the MPS provider has the discretion and permissions, then that could lead to capital gains tax liabilities, as the client is still the ultimate owner of the underlying assets, despite it being managed by an MPS provider. So typically an MPS you'll generally only hold within a pension or an ISA wrapper, just so there's there's no fees or there are no potential capital gains tax liabilities for the end client when rebalances occur. So I'm just conscious that I'm running out of time, so I'm having to speed up through some of these. So another common question: do I have to include an MPS in my CIP? Again, as per the ultimate of multi-asset funds, no, you don't have to include anything in your CIP. But if you have clients which are more sophisticated investments, they like, the additional literature that an MPS provider might provide, additional market commentaries, a little bit more invested in how their money's being run. If they have dark green ESG preferences, if you find a significant commonality within your client bank that, some of these features that I'm spilling out may apply, then maybe it is useful to include an MPS in your centralized proposition. But a CIP, as we'll come to later, doesn't have to be a catch-all for an advice firm. So if you feel it will if it will add value to your firm, if it will add value to the clients, then yes, you should include one. But no, it's not mandated. The FCA won't, come shout at you for, or impose sanctions for not having an approved CIP, an approved MPS. Sorry. So advisor model portfolios. So I'll just whiz through this one relatively quickly because I'm going to plug our event on the 22nd of June, where we have a full build session, so a full morning session as we have today, where it will be dedicated to advisor model portfolios. So an advisor model portfolio, so instead of outsourcing the portfolio management, so the fund research, the rebalancing, instead of giving that responsibility to an external provider, it's where you will manage these in-house. So that will give you a total control of the investment strategy, so you're able to tailor make a range of your own risk profiled portfolios to various levels of risk. You're able to include whichever funds you want, you're able to exclude whichever funds you want. You can totally bespoke a range of portfolios if you feel a big bank of clients will be sufficient to gain benefit from it. So, however attractive an advisor model portfolio may sound, there are some considerations. So I believe Brooks McDonald in next month's build session will be covering these considerations in a lot more detail. But there are a lot of things that, as an advice firm, that you'll have to be mindful of if an advisor model portfolio sounds appealing to you and your firm. So the first thing is asset allocation. So where do you get that from? Is it an off-the-shelf solution which will bind you to something that you, again, it will just bind you to a similar set of an externally provided asset allocation, or if you want to partner up with a firm to build your own asset allocation. So if you have very specific preferences for these portfolios or very specific objectives, then you can outsource your own bespoke asset allocation, but these run very, very expensive if you were to outsource this. So because there are lots of huge teams of analysts that will come together to, look at the macroeconomic environment, microeconomic environments, how different geopolitical situations are interacting with one another to come up with where to put money, then there's a lot of research that goes into building that bespoke asset allocation. So it just depends on how or what framework you want to build these portfolios out of. So there are some risk profiling tools as well that will provide an asset allocation to build these portfolios too. But again, you're kept quite rigid within where you can put that, so then it kind of takes away some of the positives of being able to fully bespoke your own range of portfolios. So the next one is discretionary permissions or lack thereof. So what we just discussed with MPSs, where an MPS provider will just at the click of a button, they will have done all of their research. They will consider how the markets are behaving, whether there needs to be any sales or repurchases or rebalances within their portfolio ranges. Then the MPS provider can just do that from their side. You don't have to contact the client. The client doesn't have to worry. The MPS takes care of all of that their side. Their portfolio will remain in line with their attitude to risk or their risk profile. It will remain positioned according to the current markets. But where you bring this in-house, and if you don't have discretionary permissions, so of course they are obtainable, but at a cost and lots of forms to fill in, lots of loops to jump through. If you don't have discretionary permissions, every time you want to make a change to a client's portfolio, it will have to include some communication, some suitability assessment, and the client to actively sign off. So the client will have to acknowledge that and approve a portfolio rebalance. So whereas an MPS provider can just do it like that, then with an so if you take it in-house and don't have discretionary permissions, then there's lots more administration loopholes to jump through, and then you end up in the situation where some clients may not respond. They might have disappeared for a month on holiday, traveling across Europe, and you can't get hold of them, and their portfolio remains significantly out of balance following a significant market event, for example. So I guess that's kind of extreme, but there's some of the kind of pitfalls. But that without discretionary permissions, then they are difficult to manage consistently across a number of clients. So other portfolio administration, so you'll need to have an investment committee that will meet usually quarterly to review and research the funds, review performance. Are the funds still behaving? Are they still interacting with each other as you're expecting? And just to discuss this as part of an investment committee meeting, just to determine whether the portfolios are still behaving as they should be. Are they still suitable? Are any rebalances needed and things like that? So with an investment committee, it's always recommended to have somebody of at least a CFA level of certification, so a chartered financial analyst. Alternatively, someone who has been a former fund manager or former asset manager, and who has credentials to oversee how you're running these portfolios, just to make sure that you don't run into any kind of compliance trouble. So again, if you don't have somebody of suitable qualification within the firm, then it can be quite expensive to bring somebody in on a consultancy basis to oversee that. Then the last thing to consider is the research time and cost involved in managing those portfolios. So again, it's a lot of time in FE, it's a lot of time in various other asset analytics softwares, just to make sure that everything's behaving as it should. And do you have the time as an advice firm to dedicate it to these kind of portfolios? Then if not, then it may be best to outsource. And if you do, and you've got a significant number of clients that you feel will benefit not having an MPS fee on their charges statement, if you would like to bring it in-house, if you've got a particularly bespoke set of objectives you wish to follow, then advisor model portfolios can be very, very handy. So there's also, as Brooks Macdonald will touch on, there's also some halfway houses as well that can be accommodated with various firms, and through partnering with a discretionary service, you are able to offer a bespoke solution, but just not as bespoke, I guess. But yeah, Brooks Macdonald will cover that on the 22nd of June. So it should be an interesting watch. So next, I just wanted to cover smooth multi-asset funds. So this is where within a similar fund structure, so it will be underpinned by property, it will be underpinned by cash, it will be underpinned by equities. The fund providers of these types of solutions will manage the unit price separately to how the assets are actually behaving underneath. Then the provider offering these smooth multi-asset funds will aim to provide a consistent unit price increase for those clients who are particularly risk averse, who don't like seeing the daily or monthly volatility of their portfolio gaining 5%, then losing 10%, gaining another 7%, dropping 2%, and just being all over the place. So smooth multi-assets aim to provide a more consistent return profile and may be suitable if you have a lot of clients in your client bank who are risk averse and who wouldn't prefer to, or who prefer not to see that daily volatility. So another strong application for a smooth multi-asset fund are those clients who are in drawdown. So because a particular problem with regular sales out of invested assets, then having a smooth multi-asset funds limits the potential of a market crash having a huge impact on just a straightforward unit linked solution. So smooth multi-asset funds are handy for drawdown, just so that you don't end up in a situation where you are pound cost ravaging and selling at the low point. So after every dip in, so say if the monthly sales to facilitate a client's monthly drawdown or monthly income, if they all happen just after even some small dips in investment value, then you're removing a lot of, or you're selling those units at a less favorable price, whereas a smooth multi-asset fund will keep those nice and consistent. So these are quite popular, sort of like the short to medium term pots in a potted drawdown strategy, or if it's feasible, then just to have the entire client's retirement fund in a smooth solution, just to alleviate this problem and to make drawdown a little, or to remove some of that risk out of a drawdown strategy. So, do you need a smooth solution in your CIP? No, you don't have to have one. But again, like a broken record, and if you have a client bank that will support the repeated use of these smooth solutions, then by all means include one in your CIP. I'll reiterate, there's no regulatory requirement to include one of everything to have on hand. Then you don't have to include a smooth solution. But if you have a particular client bank that you are finding yourself doing bespoke research over and over and over again for, then that's when to consider to include something like this. But for most firms, these smooth solutions are pretty niche, and will only arise when there's a client who's wants a little bit, who has a slight appetite for investment risk, but doesn't want to just keep all their holdings in cash, and who has an appetite for further growth. So also we've had firms within Verve who we've worked with on DNA, who have dealt with a lot of clients who they will get referred from lawyers' offices. So for those who are going through a divorce, who might not have particularly strong investment experience, where they've never dealt with family finance before, then smooth solutions to try and reduce that volatility risk might be the best. So bespoke discretionary. So I'm very conscious I've only got 4 minutes left to run through all this, and my final slide as well. But a bespoke discretionary, this is basically an MPS, but where instead of an off-the-shelf solution, a portfolio manager will put together a totally bespoke strategy for a client. So this means that as well as the investment strategy being totally outsourced, then the tax strategy can also be totally outsourced. So bed and ISA, bed and pension, the discretionary manager will look after that, manage tax allowances. They can also be brought into client meetings to discuss their investment strategy, to discuss the market conditions, all sorts of things. So a bespoke provider. So it's less on, I suppose, their investment track record, but it's more what else they will embellish their service offering with. So again, it could be literature, it could be meeting with the client in person, it could be bringing them in with their annual reviews. But these kind of portfolio managers, they will come at a cost. So they're usually about 1 to 1.5% for the ongoing annual cost. So they are quite pricey for what they offer. But in some cases, if it's ultimately suitable for the clients, if they have specific ethical values, if they've got very complex tax strategies to negotiate, then even though it is costly, then that might be highly valuable to the client and then perfectly justifiable to include. So the minimum assets under management as well. So a lot of DFM providers will state something about like something on the order of a minimum contribution or minimum initial contribution of £100,000. Just to qualify, that puts it out of reach of a lot of lower to mid-level clients in terms of assets. So do you need one? No. Again, FCA don't mandate what goes to CIP. CIP is not a regulatory requirement, and therefore you don't need to have one on your CIP if you don't have a lot of clients that won't see value in them. So just to round up, I do have a little note on value and consumer duty. So when it comes to value, justification is always the key. So a CIP, it was always going to be totally bespoke to your firm. So it doesn't matter what other firms are doing. It doesn't matter what platform the firm down the road's using or what they're recommending. A CIP should always be built off your own bank of clients and tailored to different client segments and justified based on their individual needs. So although it's not a regulatory requirement, I've already mentioned that it's very handy to have one as it helps articulate. So if the FCA ever do come and start trawling through files, then it's very handy to have a centralized proposition ready just to hand over and say, these are our client segments, these are the platforms we use, these are the investment strategies that we have determined will be suitable for each one. So Again, it all comes down to value and a rationale of how you link investment strategies to different clients. So even in the wider world, like the analogy that I keep bringing up every, like it seems like basically every little event that I do with Verve, it's bringing up car analogies. So say if you are looking to buy a new car, and you will see features in a car that you will want, that you can see some value in, even though they are a little bit extra. So, for instance, the brand and reputation of the car you're buying might carry a bit more weight. So, it might be more appealing for you to be seen in a Mercedes than it is to a Honda. So, that's no shade on Honda because I drive a Honda, but there are some brands that carry more of a reputation for quality that some people will be willing to pay a premium for. The same with investment world. So a longer and more established historical investment management firm may carry a bit more of a brand value to clients or to advice firms. Then this can also be extended to the analogy with like a manual transmission versus an automatic transmission. Some clients may prefer the car to change gear itself and be able to pay a little bit extra for the car to manage itself, change lanes itself, self-drive. So that could be the analogy for an MPS or a discretionary portfolio provider over a multi-asset strategy or a bespoke portfolio put together by the firm. So it may be preferable for the client to pay a premium to have it managed on their behalf. And even lastly, when it comes down to environmental credentials, clients may value the green credentials of a car like a hybrid or a fully electric car. So even in the real world, clients are more willing to pay a lot more money for cars with green credentials and that are more sustainable in the long term, over a standard car. And again, this transpires to sustainable investing. So some clients may be willing to pay an awful lot more money if their needs are fully catered for, rather than just be stuck in something that will do the job at the end of the day. So a car is just to get you from point A to point B. But then there are also the factors to take into consideration when you throw value into the equation. And then that's how I would approach justifying investment strategies for different client banks. It's, will the client see value in what I'm recommending? And just to be able to justify that as part of your centralized research, this is the client bank, these are the strategies I'm recommending. Yes, it's a little bit more expensive, but here is X, Y, and Z reasons why I believe it's a valuable solution to this client bank. So sorry, that was a little bit quick at the end there. So conscious that I've overrun just a little bit. Just to wrap up, so you must be confident in those investment strategies you're recommending to clients, because confidence from you will transpire into the client's confidence in you as a firm. If you are able to be passionate about what you're offering and how it's suitable for their needs, then it's going to promote a lot better and more trusting relationship between you and your clients. And then also from a regulatory ticky box standpoint as well, it's also very useful to have that to present to the FCA in where you are adding value to your client bank. And there we go. That just about wraps it up. So I'm conscious that I've overrun a little bit. So I'll have a little run through the chat box. So I did see there's a few questions come through. So what I'll do, I'll follow that up with you individually afterwards. But in the meantime, thank you very much for listening. Any further questions, again, feel free to chuck them in the chat box over the break and I will pick them up after the event. Or you're also able to pass them on to Verve directly, or you're able to contact me at Verve as well. Okay, thank you very much for listening. I'll see you at 10:30, where we will be handing over to Lee at PIMCO, who will be talking us through the current state of the bond market and their value in investment strategies going forward. Thank you very much, and see you in 11 minutes.
Hello everyone again. Hope you had a nice break. Managed to get yourself a cup of coffee in readiness for Lee. So I'm going to hand over to now. So yeah, I'll let you pick up on the introductions, and yeah, looking forward to your presentation.
Great, thank you, Alistair, and good morning all. Hope you all have had your coffees and are recharged. Thank you also for joining this morning, hugely appreciated. As we dive into centralized investment propositions in this particular session, with a closer reference and look at fixed income allocations within your broader portfolios. Just by way of an introduction, yeah, my name is Lee Deneen. I head up our retail sales division here at PIMCO, where I have been working now for just under 2 years or so. Pre-PIMCO, I was at M&G for around about 13 years, and within financial services now for about 25 years or so. In terms of the presentation today, really over the course of the next 45 minutes or so, I guess we have a spread of knowledge bases on the call today. So I've kind of tried to position it as somewhere in the middle. If you find it overly technical, please feedback and we'll simplify it next time round. And equally, if you don't find it technical enough, let us do know. And again, we can tweak and alter for future sessions. Equally, more than happy to come and talk to any of you individually or as firms off the back of today's presentation. So please do get in touch, hook me up on LinkedIn, or please come via the Verve group. They have my details, and we can engage as we go forward. So questions, more than happy to take as we go. Please feed into the chat box. If I don't get the chance to address them through the course of the presentation, I shall pick them up post-presentation, get in touch with you directly. So in terms of the agenda today, really 5 key points that I'd just like to work through, which I think are kind of pertinent with regards to portfolio construction and a consideration of centralized investment propositions. So firstly, what does today's global bond market look like? As I'm sure all of you will be more than aware, last year was quite a unique and differentiated year for certainly for fixed income returns, and it was to the negative, as you'll clearly be all aware. It was really once in a generation, that the worst downturn in fixed income markets since records have began. So I think it does beg the question: what does the market look like today? And I guess within that context, what role should fixed income play within your portfolios, given that last year was so differentiated? We did see correlations really come together with that of equity, and both fixed income and equity falling at the same time, which didn't help with diversification benefits. One question we're getting a lot of at the moment is regards to allocations within fixed income. So should you as advisors and portfolio constructors be thinking about UK or domestic allocations, or actually should you be considering more global allocations with regards to your fixed income exposures? And interestingly, as PIMCO, the world's largest active fixed income manager, we have seen, I would say, an acceleration of inquiries in the past 6 to 8 months, where firms have been asking us about global exposures and moving away from UK exposures, really from a diversification perspective. And we think kind of the acceleration and the catalyst for these questions has really been around the kind of quasi-Cartang, the kind of trust debacle of last year, where we saw UK domiciled fixed income assets kind of really draw down and sell off quite severely through that time. So a consideration of broader diversification benefits of thinking more globally. So we can touch on that. And then with regards to, I guess, fixed income construction, what should you be thinking about in terms of portfolio positioning in this point in time? And lastly, where are we at in this point of the cycle, and what can we learn from history? What lessons can we learn from previous cycles? And we'll just finish with a close and take away. Before we dive into the detail, I'm going to give this a try. Hopefully the tech will work, just to check that you're all awake and engaged and with me through the course of this presentation. I've just got a quick poll, which hopefully Jazz is going to jump on here. So I have 2 questions. A little bit factoid-like, but yeah, just to give you get the grey matter turning over and thinking fixed income. So the first one is, what is the size of the UK bond market? So I'm not quite sure how the tech is going to work here, Alistair. From a polling perspective, I'm not sure if there's anything popped up on screens or not. How has that worked?
Yeah, it's popped up on my screen. So everybody within everyone's responding to it now. It's all
Great. You've got an A, B, or a C option hopefully in front of you there. Just give me the nod, Alistair, when everyone's sort of totted up there and given a response.
It's just in the chat box. Are you able to see it? If there's like a row on the top, it'll say chat. Then all of your responses, you'll be able to see them coming through live back.
Okay, yeah. Yeah, I can't see it unfortunately because I'm in a different screen with the sort of presenter mode. But yeah, what's the most common response? Maybe let's just go
Okay,
for that.
so we've got so for A2 trillion, we've got 9 respondents. For $4 trillion, we've got 6 respondents, and for $25 trillion, we've got 8 respondents. So
Okay, so
fairly even spread across the three.
a good even spread, like it. Hedged your bets, audience. Thank you. The actual answer is B. It is 4 trillion US dollars is the size of the UK bond market. Now let's consider the global equivalent. Hopefully another poll will pop up in front of you. Here you have a couple of options. Is it 10 trillion, 75 trillion, or 128 trillion? So again, a pretty big spread of numbers. Please pop your answer into the chat box there, and we'll just see where the numbers come in. Alistair, again, if you could just give me the spread, perhaps the most popular answer, and we'll kind of go from there.
Yeah, so not got many for 10 trillion, but it's level pegging for 75. So we've got top votes. We've got 10 respondents for 128 trillion so far. So I'll let everyone filter through for everyone who wants to pop their vote in. Do a little countdown. 5, 4, 3, 2, 1. So we've got 10. We've got 1 vote for 10 trillion. We've got 10 for 75, and 10 for 128. So it's absolutely neck and neck for the top two.
You can see what I've done there. It's a little bit of a leading question, so we clearly have a savvy audience. The answer is C, 128 trillion. So quite a considerable difference in that of the UK and global when thinking about the sizing of the market. And we'll kind of come back to this point in due course and what that means for portfolio construction in terms of broader considerations of the sizing of the market. Before we do that, I'm also extremely conscious that I'm sure some of you are aware of the PIMCO brand and will know as well. Equally, some of you perhaps less so. So really just a very brief introduction to the PIMCO business. So yeah, as mentioned, we are the world's largest active bond manager. We manage just shy of 2 trillion in assets. PIMCO, interestingly, stands for Pacific Investment Management Company. So we are headquartered over in the US in a place called Newport Beach. If you can just look on the left-hand side of the US map there, which is about 45 minutes south of Los Angeles, facing over the Pacific, as the name suggests. Founded in 1971. So just over 50 years ago now. As you'll see on the map, we have investment professionals right across the world. Certainly from a global perspective, we have people on the ground speaking local language, local dialect, local relationships, local researchers, which is vitally important for managing portfolios around the world. Probably my favorite PIMCO stat is in 1980, which doesn't feel like that long ago to me, actually. PIMCO had 30 staff and 300 million in assets under management. So to today, 3,500 staff, just shy of 2 trillion in assets under management. Yeah, that's some considerable growth curve. Now, you don't grow to that extent without one, providing alpha and excellent investment solutions to our clients across the world, but equally offering first-class service to back that up as well. So if you're not aware of PIMCO, please do engage with us. We'd be delighted to talk and engage with you into the future. And in terms of some of our viewpoints and shaping considerations when it comes to kind of macro themes and considerations, one of the themes and things that PIMCO is well known for is its economic viewpoints and forums that we run within our business. If ever you watch Bloomberg, you'll see that we regularly have speakers extolling the views on how we see the global markets. And these economic forums really come together with all of our portfolio managers, investment experts across the world. We'll gather in Newport Beach 4 times a year to really consider our kind of cyclical outlook. So that's how do we see markets evolving over the next 6 to 12 months. We do that 4 times a year. Then once a year we get together and consider secular trends. So really this is a consideration of kind of 5-year perspective, so longer term themes and trends that we need to consider from an investment perspective. So for example, the transition from brown to green would be a multi-year, multi-phase consideration. The integration of AI into the world as a multi-year consideration. We clearly, it's coming to the fore right now with the likes of ChatGPT, the inflationary spike that we've seen play through over the past 12-18 months, and equally a forward-looking perspective, what that means for global markets. They would be broader considerations that would feed into our bigger picture views. So that's the macro piece. Some of the views I will share with you through the course of the presentation today. And equally, given our size and scale, and you can argue, is scale and size good or bad? I think in this instance, in terms of resources, it's an extremely good and brilliant thing for PIMCO, because we have a global advisory board, and on that board we have some globally renowned financiers, the likes of Ben Bernanke, the former chair of the Fed, Mark Carney, obviously the former governor of the Bank of England, Gordon Brown, the ex-PM, amongst many others, renowned academics, Nobel Prize winners. And these guys come and talk to our investment committees, offer perspectives and viewpoints, obviously within their own networks, and equally within their own knowledge bases, in terms of challenging our thoughts and perspectives, making sure that we don't follow each other like sheep. There's no groupthink. So an really excellent resource for the PIMCO business. So let's address some of the important questions. Let's get into the detail. What does today's global bond market look like? So some of the headlines that you'll see on a regular basis, not just in terms of fixed income markets, but more global markets in general, things such as rising rates, inflation, big considerations when it comes to fixed income markets, but equally, recessionary risk, liquidity. Are we about to enter a bear market from an equity perspective? There's a lot going on in the markets right now, and there continues to be. And I guess as we just cast the lens in terms of some of the key drivers of fixed income markets, we're really at interest rates, inflation, and kind of credit risk. Here we can just see kind of where we've got to from an interest rate perspective, and clearly we've gone through a dramatic acceleration of where we were to where we are now in terms of rate rises. The most aggressive rate hiking cycle in history, as we can see through the course of the past decade. Rates have dramatically increased. Interestingly, this chart was put together at the beginning of this month. Even in the short time through the course of this month, the market expectations have changed, and changed quite significantly. Certainly here in the UK, I'm sure you would have all seen the inflation print of yesterday coming out higher than expected. Yes, some base effects in terms of oil and energy prices coming off a little bit, because they just can't keep accelerating at the same pace forever. But still some extremely sticky and concerning inflation reads. Food in particular coming out at 16.1%. So any individuals or clients that have families, putting food on the table is an increasing cost base in terms of disposable income. So we're terming it kind of sticky inflation. The market seems to have latched onto this kind of terminology in terms of sticky inflation. What this means for interest rates are, despite there being a shorter term consideration that we might be somewhere near the top, actually, as of this morning, the market is now pricing in a further 1% rise in interest rates here in the UK. So from 4.5 to 5.5. Over in the US, actually, we do think we're pretty close to the top in the US. The spread is between 5 and 5.25 at this point in time. Perhaps one more to come, but if not, we are at the top in the US. They're a little bit further ahead in the cycle. I guess the interesting point is in terms of future market expectations, and this is perhaps where PIMCO's view is slightly different to that of the market. With the market thinking that actually we'll see rates come off a tad and rate cuts towards the back end of this year, we actually perceive at PIMCO that rates will remain higher or elevated for a prolonged period of time. We think this because we just think inflation is likely to be sticky. So yes, we will see base effects play through. Yes, we will see inflation come off towards the back end of this year. However, it's going to be difficult to get it down to the kind of Bank of England, Fed funds target rates of around about 2%. We believe it's going to hover around that 3-4% mark for quite some time, meaning that rates will remain elevated for a period. That actually it's a good thing for fixed income, because yields remain elevated. A nice coupon will tick in. So from an income generation perspective, that's really not necessarily a bad thing. And in terms of broader considerations and the repricing of fixed income, we touched upon, or I mentioned very briefly, the journey of last year, the drawdown in fixed income assets across the piece was a painful journey for investors that were part of that journey. However, for those that are considering investing today, or certainly looking at reallocating or rebalancing portfolios, yields have really increased meaningfully across sectors, meaning actually fixed income is offering an attractive entry point right now. Fixed income is paying income once again. Bonds are looking alluring. Bonds are back, pick your phrase or terminology. But actually, if we just pick the kind of center chart here, kind of right in the middle, investment grade credit, which is a bedrock of most portfolios across the UK, you can see a real expansion of yield, a real opportunity set now in terms of income buffer, but also diversification within portfolios. Really no great need now to take a huge amount of credit risk to generate 5, 6, 7% returns on a forward-looking basis. Interestingly, by comparison to equity, you kind of think about 6, 7% return profile, not a million miles off the long-run average return profile of equity, with significantly now on a forward-looking basis, less volatility and diversification benefits back. So again, a broader consideration. We'll kind of get into that a little bit deeper and unpack that a bit more as I go through the course of the presentation. Interestingly, so we talk about rate hiking cycle, and this is just a bit of a perspective on kind of how bonds have performed as we've gone, and this is government bonds, this particular reference, how government bonds have performed as we've gone through rate hiking cycles in the past. Now, this is just looking at the past decade, really, the past decade plus, 12 to 15 years or so, and where we've seen government bond yields rise and how much they've risen by. You can see them on the chart here. And the important consideration is the forward-looking return, or the forward return 1 year thereafter, this increase in yield. And as you can see, in pretty much every instance, the numbers look pretty healthy from a forward perspective. And again, we'll touch upon this as we go through the presentation, but from a forward-looking indicator, this rise in yield should represent a better opportunity to drive some decent returns from fixed income as we look forward. So what role should fixed income play within your portfolios? Now, fixed income can offer several benefits to a client's portfolio, but I guess the core question would be, what are the benefits for you as advisors? What should you expect from your fixed income portfolios in today's world? Well, really, there are a couple of considerations here, kind of three core ones, really. I'll just touch upon them at a high level to start with, then we'll get into the detail. The first one is kind of capital preservation. So fixed income has historical kind of low volatility, limited drawdowns. From an income and total return perspective, fixed income has provided a stable source of income and total return. And from an equity diversification perspective, fixed income has really provided strong portfolio diversification, particularly to equities in normal market conditions. So let's just unpack these kind of one by one, really. So the first one would be kind of capital preservation. Now, fixed income has historically had low volatility and limited drawdown. And if we look at just the left-hand side here, the chart, we just use kind of bellwether indices here. So the S&P 500 and the Barclays Bloomberg Global Ag, that's a representation of kind of core fixed income in the world's biggest fixed income market over in the US. And clearly you can see from a volatility perspective, yes, there has been, significantly less volatility through time, but a third of the volatility of equities. So that's the vol piece. And in terms of drawdown, if we look at the right-hand side chart, again, using similar data going right back to 1978, here you can clearly see we've had some significant drawdowns from an equity perspective. 1987, the tech bubble bursting in 2001, obviously the great financial crisis of 2009 as well. And actually through those periods, from a volatility and dampening drawdown perspective, kind of fixed income has really done its job. So kind of capital preservation would be a core consideration around fixed income allocations. Considering the longer term, actually, and thinking about kind of rolling 3-year periods, negative returns from high quality fixed income actually has been really quite rare. This data set goes right back to 1978, so really since records began, certainly for fixed income indices. And really what you can see here is yields or coupons have really been a driver of return through time. And here you can see the kind of consistency with the green line running through this chart of those coupons and dividends kind of playing through by comparison to the more volatile ride of equities. Yes, with equities, absolutely, we've got some nice peaks here and some potential to really drive return, but equally we've got some pretty deep troughs as well, as mentioned. 2009 in more recent history certainly stands out, as well as 2001 there in terms of those drawdowns. So really, considering that 3-year number, very rarely through time has fixed income got below that 0 percentage point on a rolling 3-year basis. Obviously, recent history would be a prime example where we have just dipped below that line on a rolling 3-year number, a particularly unique period in time and in history, and I'm sure we'll look back on that as being very much the case into the future. And last but not least, from an equity diversification perspective, so high quality bonds can certainly assist with preserving wealth through periods of historical equity drawdowns. That's what we've seen. And again, we've just considered all the major drawdown periods here over really the past kind of 12 to 15 years, going back to the great financial crisis, and pretty much all bar the standout of last year. Fixed income has provided a nice kind of buffer diversification piece in terms of portfolio construction. So I talked earlier about UK or global bonds in terms of consideration of allocation, and really lots of thought and consideration gone into when it comes to centralized investment propositions, kind of what's the best consideration from a forward-looking perspective. And I kind of touched on this point at the start, and I think it's a really important one when thinking about allocations. So firstly, let's just consider this is just the global corporate bond markets. This is excluding government debt, so gilts, treasuries, bunds, etc., just corporate bonds. And what you can see here is on the left-hand side is the size of the corporate bond market globally. It's around about 12 trillion in size, a pretty deep, broad market. And actually, from a UK perspective, if you're as allocators just allocating to the UK, you are really limiting the opportunity set. Just 4% of the global corporate bond market is attributed to the UK. In fact, considering the global picture is 23 times larger when thinking about global allocations. What does that mean in terms of concentration of issuers? So this is from a fund management perspective, companies that we can lend our money to for a period of time, hopefully get it back after that period of time, be it 3, 5, 10 years, whatever it might be. But equally, there are 6 times the number of companies issuing debt that we can lend our money to when considering a kind of globalized perspective. Now, kind of which means what does that mean for the portfolio construction? Well, if you were to consider, I guess, more global allocations, we've got diversification is very much the title of this slide. What it means is exposure to different economies at different points of the cycle. It really reduces idiosyncratic risk. So the fact that the UK may blow up from time to time, you're really reducing that risk. You're also enhancing liquidity through broader, deeper markets, and equally with greater choice comes the ability to generate greater alpha opportunities by broadening essentially the investment universe. And if we just think about our own fair shores here in the UK, and perhaps a home bias, which we all naturally have here in the UK, which is certainly seen through portfolio construction. We're not really, having to go back that far to say there are a number of examples in recent times whereby actually, UK allocations to global allocations, the UK perspective has been particularly challenged. So 2008 and 9, pretty yawning gap between that of global and UK returns. We've got Brexit, clearly very specific idiosyncratic to the UK, and also we've got the debacle of last year with the LDI crisis, where the UK sold off again quite indiscriminately with some tangible drawdown numbers. So greater diversification benefits may, of course, reduce idiosyncratic risks of the UK at any particular point in time. And really what that means, I won't dwell on this chart, it's quite a simplistic one. What you have are stronger returns, so the drawdowns by taking global perspectives are less than narrowing just the UK opportunity set you've got. So stronger returns, you've got lower volatility by having a greater spread of assets across global markets, which essentially means greater or enhanced risk-adjusted returns. So considerations when it comes to portfolios. How should we be thinking about today's market? What are the key things to indeed be thinking about? Well, I think with regards to portfolio construction, I guess any portfolio, you have to have a set of objectives. So what are you trying to do when building or thinking about portfolio construction? And risk tolerance is absolutely a starting point within those considerations. So here we're just looking at almost the classic risk spectrum, from less equity exposure on the left-hand side here to more equity exposure on the right side. And you've got the denominations of equities and bonds represented, bonds by green, equities by the blue. And as you can see, on the left-hand side of the chart, the lower risk portfolios, they do have larger allocations to fixed income. This may serve primarily as a source of income and indeed total return. And clearly, the asset class being less volatile sits more naturally at that cautious end of the market. At the more riskier end of the market, typically smaller allocations to fixed income, primarily used as a diversifier when it comes to those more riskier portfolios. I think also interesting to consider is what types of assets sit within these fixed income allocations. So at the kind of the more conservative end of the market, that would be more kind of government bond, core bond allocations, less so kind of riskier credit or step into high yield or perhaps even emerging market debt. That's really going to affect the risk reward dynamics within the portfolio. So importantly, within fixed income, a consideration of where within the risk spectrum portfolios sit from a fixed income allocation perspective. Now, within that remit and thinking about fixed income, it's really important to consider what are the drivers of return of fixed income assets. And they typically are the duration profile of a portfolio. So that's the interest rate sensitivity of a portfolio or fixed income exposures. It's the credit quality of the portfolio. And I guess from a centralized investment proposition, the other consideration would be, do you go active or do you go passive through that time? These are some of the key considerations when it comes to portfolio construction. And really just to overlay those viewpoints with kind of how we at PIMCO see the world today in terms of positioning. So what we have here are considerations of where we might be during the course of the cycles. First, let's take interest rates. Now, in a rising interest rate environment, which we went through the course of last year, from a portfolio construction perspective, it would have been prudent and wise to have lower duration allocations going into 2022. This would have meant that you had protection, so to speak, from those real rate rises that played through. On the other hand, if we were to see interest rates falling away, actually you want to go overweight duration and take more interest rate risk with regards to your fixed income allocations. At the moment, we've got a tick here by our neutral duration perspective. So we're not over, we're not under, we're around about benchmark allocations for a lot of our portfolios, really just in that kind of wait and see mode before we go to an overweight position. We haven't quite got through the inflationary spike. I think the picture is still a little unclear in terms of where this might actually land. So we're taking a kind of neutral duration perspective at the moment. Clearly, we've had a lot of rate rises already. So we were underweight. We've shifted that to neutral, and at some point we will go overweight when we become a bit more confident on the outlook. From a credit quality perspective, so this is all about the quality of the issuers that we're lending to, and dependent on also economic growth or recessionary environments. So if we're going into a growing economic environment, actually the quality of the underlying portfolio, if everything's kind of growing and growing nicely, the quality of the portfolio is less important because the tide's rising, bringing everything with it. Through tougher economic times, i.e. recessionary environments, it's really important to have a consideration of the quality of the portfolio. So at this point in time, we are very cognizant of tougher economic times ahead. So we've really shifted our portfolios to a quality overweight bias, meaning we're lending to the biggest, strongest businesses that are likely to survive and weather a recession that little bit better. And equally, to that, we do believe that actually, with volatility, it's good, it's better to have an active manager sat behind you that can make tactical choices in terms of allocations within sectors and within a quality perspective to navigate the slightly more volatile times that are ahead. just touching on expanding on one of those points in terms of kind of credit risk and equally kind of the spread of taking credit risk. Here we can just see the differential spread you can get in taking IG risk, so investment grade risk, which is the blue bar running through this chart, and indeed also the high yield index, where you get a little bit more yield because you're lending to companies that aren't quite as financially strong. I guess where we are at in terms of valuations right now, kind of fair really by all accounts in terms of investment grade, just under fair value in terms of high yield. But again, we're really concentrating on that kind of blue bar running through this chart in terms of the more kind of high quality credit part of the market that's likely to be more resilient as we go through this next phase of the cycle. And just a consideration as we look at the broader numbers in terms of how active bond fund managers have performed versus their passive peers. Interesting to see, if you look at the left-hand side of the chart here, by comparison to the right, this is the active passive split from an equity and bond perspective. This is across industry, actually. This is not PIMCO specific. Fixed income or bond managers typically have been more successful than their equity counterparts at generating alpha through time. As you can see here, intermediate core or core plus bonds, which is where most people allocate to or need high yield bonds, 81 and 91% of active managers have outperformed their benchmarks consistently through time. And interestingly, we kind of often get asked the question, why is that? Why does active management tend to work a little bit better in fixed income markets? And really, it comes down to a number of points and inefficiencies largely within the market, and I'll just touch upon them briefly. So first is kind of market structure. The bond market is large, it's extremely complex. 344,000 issuers across the world, the 128 trillion that I mentioned at the start of the presentation in outstanding debt. And equally, even within that universe, not all investors are trying to profit maximize. They're not all investing for profit. That can create opportunities for those that are trying to invest for profit. So, for example, central banks, buying bonds, which they have been doing through the course of the past decade, to influence interest rates and money supply. That's a big market mover, and it can be extremely beneficial to active managers looking to make a play on that. The index structure, it's kind of suboptimal, it's complex. Just the US indices, the Barclays US aggregate, again, a bellwether indices, there's over 10,000 securities. And by comparison to that of equity, we're actually the largest weightings within industries are typically the biggest companies, the most profitable companies. It's almost the converse for fixed income indices, in that the largest weightings are often the most indebted issuers. So it begs the question, does that dynamic necessarily play through? Is that what allocators wish to have access to by buying in indices? Is the most indebted form the bigger part of the indices? Equally, very, very difficult to replicate. Full replication comes in at 30 to 70% or so, certainly through ETFs. I won't touch on all of these points, conscious of time and just moving through the presentation, but there was reference points through the rest of the presentation for you guys to pick up. In terms of lessons from history, so as we go through this current phase of the cycle, as we see recessionary storm clouds on the horizon, kind of what can we learn from historical cycles in terms of where things are at and where we might go next? Now, we have been late cycle for a period of time, and actually what we've deduced by our research, our client solutions and analytics, our investment committees and data that we run through a variety of internal systems at PIMCO is kind of real assets tend to perform well in late cycle, where core fixed income help prepare for kind of really unforeseen recessions. Core fixed income kind of meaning government bonds, really. So we've seen real assets, commodities, inflation-linked bonds do very, very well in recent times off the back of that kind of almost kind of COVID reopening. And I'm sure we've all felt that if ever you pop down B&Q or doing an extension or adding to the house, that would have cost you significantly more than it would have done 12, 18, 24 months ago. Equally, if we look at kind of what history tells us in recessionary environments, kind of that core fixed income government bond exposure can actually do particularly well as risk assets sell off. And equally, through the second half of a recession, you get a more broad, diverse range of returns from across the asset classes, but equally fixed income still an important part of that component. So, kind of history is an interesting marker. And actually, if we look at recessionary periods or historical recessionary periods, bonds have typically provided positive returns and significantly outperformed equities through recessionary periods. Now, here we've listed pretty much every one, going back to the 1950s, where we've seen recessions. I won't go through all of them, but you can see the recessionary periods, the start of the recession, the end of the recession, what the total return was through that period of both equity and bonds. And then in the final column on the right-hand side, the differential of return of bonds versus equities. And in pretty much every instance, bar one, 2001, bonds have significantly outperformed equity as we've gone into tougher economic periods and recessionary environments. So certainly a consideration in terms of portfolio construction, and that's what history tells us. I've kind of touched upon this point already on the left-hand side in terms of kind of the why bonds piece, but on the right-hand side, really just considering, again, why fixed income might be a consideration in terms of portfolio construction. It's because it's typically enhanced the ability to reduce volatility while maintaining attractive returns. And if you look at kind of the spread of asset classes on the chart here, you've got cash, you've got bonds, you've got stocks represented by the S&P 500. Interestingly, considering the 60-40 portfolio, whether that be cash or indeed fixed income allocation in terms of the 40% of the portfolio, whether it is cash or whether it's fixed income, actually the volatility measure is very, very similar actually. But what you do get with fixed income is it's clearly enhanced yield. You get greater potential for income and return, meaning that actually from a risk reward perspective, it makes sense to have fixed income allocations within that more traditional 60-40 dynamic. So what to do in this market environment? Well, really, through the course of last year, I mentioned the references a few times through the course of the call, we saw a lot of fixed income assets rolling over through the course of last year. I guess, we haven't yet seen the equity market roll over. Perhaps that will happen, perhaps it won't, but certainly from a prudence and resilience perspective, we do think that bonds should really play an important part in conferring resilience in diversified portfolios from a forward-looking perspective. Now, I have only got one product-orientated chart in this presentation, and it's not for the sake of plugging a product. That's not what it's there for. It's really an illustration of potential forward-looking returns. And what I've got here is an example of PIMCO's income fund. It's called our GIS income fund. It's our most popular fund globally. Sits in the IA strategic bond sector. It's kind of a one-stop shop allocation, if you like, for fixed income allocations. And really the key point on this chart is looking at where we are at from a yield perspective or a yield to maturity perspective, as this is a really helpful guide for forward-looking returns. And what I've just done on this chart is I've just grayed out through time where we've had kind of peaks in yield historically. So 2013, 2015, 2018, 2019, and present day. And the key points to look at are on the table below, you've got YTM, yield to maturity. And we look at 2013, 2016, 2018, 2020, and what the yield to maturity was. And then we can, on a forward-looking basis, look at the returns over 1 year, 3 year, and 5 years. The key numbers to look at here are not the 1 year number thereafter, it's the 3 year and 5 year number. And actually the correlation between the current yield to maturity and the 3 and 5 year returns thereafter, this is annualized returns thereafter, there is a high degree of correlation. Now, given where yields are today, 6.39%, we do believe that's a really useful forward-looking indicator of where returns could be driven from a forward-looking perspective. Performance typically has been strong after yield peak. So real big indicators for us on the alluring nature of bonds again with regards to portfolio construction. I'm just about drawing up on time here, so hopefully I've kept us within our time horizons. But really, just to finish, in terms of kind of really making bonds part of your everyday client conversations and considerations when it comes to putting portfolios together. So kind of the why, the where, the how. Firstly, the why. So we do perceive bonds to be a large investment opportunity in the more broader sense. Bonds can help with defense when it comes to portfolios. Can help with principal or capital preservation. Bonds can be a great source of income. Certainly, if you think where we are today, by comparison to where we were even 18 months ago. 18 months ago, there was 18 trillion of negatively yielding debt across the world. 18 trillion, just think about that for a minute, it's a big number. As of the 4th of January this year, that number was 0. Really indicating the massive re-rating of the bond market through the course of last year. So bonds absolutely can be a source of income. Again, fixed income is once again paying income. Bonds can support portfolio diversification as well. Where might you utilize bonds from a financial planning, from a portfolio construction perspective? Now, we certainly think when thinking about retirement strategies, now that we have decent yields again within fixed income markets, certainly a consideration in terms of that the accumulation phase, that need for income. I think it has a prevalent and important place to play. Equally, legacy and inheritance tax planning, goals-based planning, be it for education, housing, travel. Interestingly, we've kind of put prospecting campaigns within this kind of where, and I guess that's just to suggest that look, there is an opportunity now to talk about fixed income again, perhaps more proactively than ever we've done over the course of the past decade, because yields have re-rated so sharply, so aggressively, meaning the outlook is significantly different. It can be used, of course, as foundations of any portfolio, and certainly enhance financial flexibility, savings, development, etc. Kind of the how. Identify clients that might be interesting in bond investing. If you're talking to clients on an everyday basis, perhaps add it as an agenda point to any client reviews to talk about the different market dynamics that are going on in today's market. Again, if we at PIMCO can assist you with those client conversations, please do let us know. We have some really friendly, informative client-facing documents that might be of use to nurture those client conversations, to nourish them in some way. Include bond overviews as part of your agenda item, I guess, as I mentioned. Discuss the need for risk mitigation during times of uncertainty. Should you be in a position to be hosting client seminars or sessions with focused product partners, again, we'd be happy to come and talk at whatever level you may wish us to talk about from a client perspective as well. And equally, this is, I'm sure, bread and butter for everyone on the call today. But ask clients if you're talking about fixed income, do they have any other clients that might be interested in fixed income allocations or resources, or just having some broader dialogue? It's a very interesting part of the market right now, and certainly PIMCO at large, being the world's largest active bond manager, are here to assist in your client conversations and your everyday portfolio planning considerations. So, Alistair, I think I've got us just about there on time, a couple of minutes early. If there are any questions, happy to take one or two, or equally more than happy to follow up post-call with any that have come through on the chat and take things from there.
That's absolutely spot on. Thank you very much for that. Fascinating stuff on all the stuff that you do on your side to I suppose keep everyone straight on bonds. And again, I suppose that we're just thinking to what I was discussing in my first presentation, right? This is the kind of in-depth research that fund managers and portfolio managers are able to take off advisor hands if you're investing via them, rather than trying to, or even then taking this into account, as Lee says, if you're constructing your own portfolios. These are the kind of things that you really need to be discussing at things like your investment committee meetings and things like that going forward with clients. So we did have one question come through from Peter Sudlow. So you just mentioned, I just asked, higher coupons are now great, but what about the capital losses of last year? What can you say about how to fix those, please?
What's the answer to fix the capital losses? It's kind of time. Unfortunately, there is no magic wand for the period that we've gone through in terms of last year. A difficult journey, appreciated. As at PIMCO, we had portfolios that were down through the course of last year. Not what we're trying to do, not what we're happy about in terms of client returns. Equally, a lot of, I guess, from a PIMCO perspective, a lot of our portfolios were perhaps more resilient than some of the market, which I guess is, in a relative sense, pleasing. From an absolute perspective, difficult. I completely understand. I think, I'd probably refer you to the potential for forward-looking returns as we go forward. I think the market has re-rated. Let time do the work. That yield to maturity number, I think, is really, really important in terms of the potential of forward-looking return. 6, 7, 8% plus is inherently achievable in our view on a forward-looking basis. So it might take some time to recoup those losses, but it is achievable. And I guess the good thing with fixed income is you have that constant drip of coupon payment of income coming into the portfolio. So through time, it should gradually build it back. But I completely appreciate, not an easy conversation through the course of last year, but on a forward-looking basis, certainly, things are looking a lot more positive.
Okay, brilliant. Yeah, thank you very much for that. So yeah, I'd just like to say my thanks to Lee. It was a great presentation. And if there's any more follow-up questions, then feel free to either pop them in the chat or as part of the post-event communications, and then we'll get those forwarded on. And I believe the slides are available for distribution.
Absolutely, as well. They certainly are. Yeah, you guys have got copies of them, so please circulate post-session. Yes. And any further questions, please let me know. But yeah, wish you a good rest of the day. Thanks very much.
Thank you very much for your time. Thanks for joining us today. Cheers.
Okay, cheers. Bye.
So for our next speaker, we're joined by Mandeep from BlackRock Investments, who I'm sure you may have heard of. So just while we get all that sorted, then we can perhaps take a few minutes. There you go. Morning.
Just a moment. We're just setting up the presentation.
Okay, brilliant. So just once you got the go ahead, I'll just pass it straight over to you, and then you can kick off with introductions and then get going if you're ready to start.
Sure.
So it's not letting me do presentation mode.
Sure. Do you want to just?
So it should work. Is that okay? So
yeah, that's fine.
Click on there, and then you're gonna have to scroll through here.
Perfect. Yeah? That's fine.
Right. Okay. I'm gonna leave. Teams meeting.
Sure. That's it. Perfect. Can you just give me a thumbs up if you can see the presentation? Brilliant.
I can, yes. So if everyone else wants to sort of say yes, they can see just to confirm. But yes, it's showing up fine for me, so I'll assume it's showing up fine for everybody on the call.
Awesome, fantastic, perfect. Well, thank you for having us. First and foremost, good morning, everyone. My name's Mandeep, and as Bodhi just clearly mentioned, I am Vice President here at BlackRock within our UK advisor coverage team. I'm joined today by our portfolio consultant, Ben Pearson, who will also be speaking later on in this presentation. Just to let you know, Ben and I work quite closely together, and the matching shirts was, of course, completely unintentional. So today I'm going to present on a much debated topic, particularly over the last couple of years, one of the most utilized strategies in our industry, the 60-40 portfolio, and whether the 60-40 portfolio is in fact dead. Now, quite an interesting story here. It's a question and topic which BlackRock's Investment Institute explored throughout last year. And since it's been publicized quite a bit, and we've actually achieved the narrative of the firm that's actually questioning the 60-40 portfolio the most, so it's good timing. I've also added some quite terrifying storm clouds on the screen today, because after all, what is more frightening than the possibility of the end of the 60-40 era? So going through some of the learning objectives very quickly today. So the first is to understand the drivers behind the breakdown in the traditional relationship between bonds and stocks in 2022. The second, to identify periods in the past where stocks and bonds have gone down together and compare with the current economic backdrop. And finally, learn how investors can build and diversify portfolios to adapt and mitigate losses in a future where the era of low rates and easy money is over. Now, I guess the most appropriate place to start would be looking back at what happened in 2022. And to put things in context, the unprecedented bond sell-off in 2022, according to Barclays US Aggregate Bond Index, was the worst year since they started recording data in 1976. So to explain the chart a little bit ahead of you, looking at valuation of assets, year-end 2021 represents the dots, 2022 the bars, relative to their historical norm. And in 2022, UK gilts were down 20%, the US 10-year Treasury down 17%, yielding approximately 3.7 year-end. In mid-October, the yield hit 4.2%, the highest since 2008. And the 2-year rate was inverted at 4.6%. Now, this inversion of the 2 and 10-year rate, it was a very important indicator of a recession. And I'm going to touch on that in a little bit more depth in a few slides' time. But in hindsight, 2022, it was very explainable. Inflation leading to rapid change in future interest rate expectations, in particular, sharply rising US short-term bond yields, although there's always naturally a lot of variables. At the Fed Reserve meeting in December 2021, they announced that they would speed up the end of bond buying and signal that it expects to start hiking rates at the beginning of 2022. Chairman Jay Powell had tipped this in his testimony before the Senate on 30th of November, and this may prove to mark the end of the period of longer-term forward guidance. Now, what was also very unusual about the sell-off in bonds is that, as we all know, it came at a time when equities sold off as well. And what you can see in front of you now is the correlation between global equities and bonds right from 1977 up until 2022. And to put things in perspective on how unusual it has become to have both negative periods, more negative periods in both bonds and equities, it only happened 3 times since 1977. And ironically, prior to 1977, it only happened 3 times as well, but those 3 times were really landmark years. The first was in 1931, when Britain abandoned the gold standard. The second was 10 years later, when the US entered World War II. And the third was in 1969, the so-called runaway inflation era, the only period really that draws direct parallels with today. But more recently, outside of obviously 2022, the last time it happened was in 2018, largely viewed as the Fed policy era, which was swiftly corrected. In Q4 2018, the S&P fell 18%, NASDAQ fell 21%, obviously quite large numbers. Over tightening monetary policy via quantitative tightening, along with trade war concerns with Trump and China, were large reasons of this negative period. Before that, it was in 2015, Chinese Black Monday, which left both the S&P 500 and NASDAQ in correction territory. And I guess looking forward now, there is certainly a demand for a new regime involving shorter, sharper business cycles, which require more frequent portfolio changes and certainly calls for more granular views. So, what did this mean for portfolios? Well, it's not the first time we've seen or heard these headlines, but in fact, our view is that the 60-40 portfolio is indeed dead, or at very least is going to be on life support for some time. We can see on the top left-hand side here, an article from earlier on in the year. Asset risk consultants stated that the average sterling portfolio plunged an estimate 9.2% in 2022. The theme continued throughout the press into the year thus far. However, the Financial Times put it pretty well. in that tough macroeconomic conditions will continue to put pressure on traditional equity and bond portfolios this year. Some investors have warned after last year's grueling market ride in which both assets plunged in tandem. So what happened to the theory? Well, continuing on the theme of correlation of bond and equity returns, Harry Markowitz's modern portfolio theory encourages investors to maximize return for a given level of risk or minimize risk for a desired level of return. And to do this by considering assets together and balance risk using uncorrelated assets. Amongst other things, this gave a rise and was one of the key elements of drivers of the 60-40 portfolio. And as you can see in front of you today, the relationship is its most extreme when we look at the US 10-year Treasury note and the S&P 500. The US 10-year tends to serve as quite a benchmark for borrowing rates, such as you can imagine, mortgage rates. The yield tells us a lot about the economic landscape and global market sentiment. 10-year rates increasing from 1% to 4% indicates growth and confidence in the economy in the future. Ignoring other factors, yields move inversely to price. So naturally, when bonds are falling, one would expect your riskier assets, such as your equities, to increase. So looking at the slide in front of you today, we can see here that from the 70s to the 90s, the correlation essentially did not exist. Importantly, since 1926, the equity and bond correlation has been positive for 98% of the time whenever inflation breached the 3% over a 5-year threshold. So you might be asking yourself now, why should we think the 60-40 portfolio should continue? Well, according to our friends over at Goldman Sachs, one reason could be regency bias. It's worked well for a long time, there's no denying that. In the 10 years from 2011, a US-focused 60-40 portfolio delivered a return after inflation of 9.1%. Something we will all on this call grab with both hands given the opportunity in this current moment in time. But even if we look at the pre-credit crunch, we can see the 60-40 mix delivered a lost decade of returns. Admittedly, quite a US phenomenon that started with the dot-com bubble and bust and ending with the global financial crisis. Now, I guess I'm going to probably repeat this on quite a few occasions throughout this presentation, and it's clear that different regimes require different methods, and we are certainly in a different regime right now. So I think we've had some freezing. Brilliant. Okay, so why is that? What's changed about this new regime? And as I say this, oops, sorry, just a moment. Skip too much. Brilliant. Fantastic. Okay, we're on the right slide. So why is that? What about this new regime? What's changed? And as I say this, I'm conscious I may lose some supporters, but the era of easy money is rapidly deteriorating. Don't like saying this, and I'm sure no one really likes to hear it. However, the pace and scale of the monetary tightening delivered by central banks in 2022 has been unprecedented, and the policy actions will continue to set the tone in 2023. Putting it in a different way, global markets are coming off life support. On the left-hand side, you can see the rapid response to inflation, with rates rising in lockstep, a massive pickup in interest rate volatility. The dotted lines state the Fed, BOE, and ECB neutral rates, and each respective color in their straight lines. Essentially, look, the picture speaks for itself. Responses have exceeded far beyond the neutral rates, which we are naturally used to. Sorry, there's a tad delay with moving over the slides, but we'll get there shortly. So I briefly touched on the inversion of the 2- and 10-year rates a few slides ago, a sign of future recession. But looking at the 2-year rate here, we can see the intended consequence of central bank intervention. First, we had low rates, then QE and bond buying pushed down the borrowing rates, injecting liquidity into the system to fuel growth. The intention of those rates and QE changes over time, in the words of the Bank of England, we first began using QE in March 2009 in response to the global financial crisis. At that time, bank rates were already very low. In fact, it couldn't be lowered any further at that point. So we needed another way to lower interest rates, encourage spending in the economy, and to meet our 2% inflation targets. Those are the words from the Bank of England. Much of that early QE went straight into the bank balance, into the bank's balance sheet, and building their tier 1 capital. However, it took massive global stimulus during COVID, the largest non-wartime stimulus, nearly 10 times as what we had witnessed during the global financial crisis. The G20 group of nations provided a stimulus to the end of June 2020, equivalent to 13.6% of GDP, compared to only 1.4% of GDP in March 2009. So here we can pretty much see the significance in front of you and the consequence of global government and central bank intervention as the consumer price inflation increased throughout all regions across the world. So here we can also see the impact of change in the discount rate. Inflation leading to a rapid change in future interest rate expectations led to the wind down of another unintended consequence of low rates and excess liquidity. The flow of retail money we started noticing into more speculative areas of financial markets, such as non-profitable tech stocks, IPOs, and crypto. The massive re-rating of risk assets based on a higher, more volatile discount rate, which has been highlighted as the rate of return used in models to convert future cash flows into their present value. Unfortunately, to some degree, our view in-house is that we see inflation remaining higher than current market expectations for some time, fueled in part by geopolitical risks, shutting down cross-border trade and reversing the globalization of supply chains. Now, the aging population, you can see on the right there, has reduced the number of workers and also kept pressure on wages. Another threat potentially we see is that the politics of inflation will give over to the politics of recession, as central banks are forced to reduce rates before we get back to that 2% level because of job cuts and slowing growth. Now, I've painted quite the dark picture over the last few slides. However, it's not all bad weather. Well, when there's volatility, when we see volatility, we also see opportunity. The massive sell-off in fixed income, combined with heavy-handed rates responses, means that fixed income finally offers some decent yields. In the case of investment-grade credit, has brightened, in our view, as we raise our overweight tactically and strategically. We think it can hold up in a recession, with companies having forfeited their balance sheets by refinancing debt at lower yields. Agency mortgage-backed securities can also play a diversified role in our portfolio, as well as short-term government debt also looks attractive in current yields. Within that, the ability to tilt towards inflation-linked bonds adds additional value to portfolios. This chart that you see here is showing the defensive qualities of the US 10-year in different regimes and doing little in the current one. Our view at BlackRock on inflation guides our view across different asset classes, tilting towards quality credit and away from, for example, DM governments. Now, saying that, everyone on the call must be thinking, well, what does this mean for our portfolios? And on this case, I will hand over to my colleague Ben, who will talk to you about what this means for portfolio construction.
Perfect. Thanks, Mandeep. And yeah, thank you everyone for taking the time this morning to be with us. So as Mandeep said, I'm a portfolio consultant sitting here in London, but working in a team called BlackRock Portfolio Analysis and Solutions. We partner with clients across the wealth spectrum and also into the institutional end as well. We do that across EMEA. I personally have a little bit more of a focus on the UK, but the key focus for us is to be clients' partners in portfolio construction, with the overarching goal of helping them ultimately to build better portfolios and achieve their objectives as efficiently as possible. So given that focus on portfolio construction, obviously you've seen Mandy run through the kind of market backdrop, what that means for some of our views in terms of different asset classes. And I guess that's a key role that I play in my day-to-day in terms of taking that portfolio construction focus, but doing so in the perspective of translating portfolio construction decisions based on the current market backdrop into implications for asset allocation, but also for implementation. So with that, I think one thing that Mandeep certainly touched on was the role that correlations play in terms of asset allocation decisions and in terms of multi-asset portfolio construction. And what we believe is that correlations play a vital role in that portfolio construction decision, and that will require a lot more frequent of adjusting the asset mix given that. So in the context of a world where we see clients bracketed based on a set level of risk tolerance, and here what we're seeing on this particular chart, we are looking at, on the left-hand side, the equity bond split of 3 different portfolios targeting different levels of risk. So we're targeting a set risk tolerance of 5%, 7.5% or 12%. And in short, obviously you can see in yellow, we're talking fixed income allocations, fairly close to 100% for the 5% portfolio. Obviously those reducing as we move up the risk target and needing to generate more of your return on the equity side. But what we also show, which is over on the right-hand side, is how that equity bond mix would need to change as the equity bond correlation evolves over time in order to maintain that same risk target of 5, 7.5 or 12% respectively. And what it shows is that should equity and bonds continue to exhibit the more positive correlation that we've seen more recently, and to Mandeep's point, actually the sort of relationship that has maybe been more prevalent over time than investors may think of if you're thinking about just more recent memory, is that multi-asset portfolios will need to exhibit changes in their asset allocation as a result of those changes in correlation. So what we see there is over on the right-hand side of that chart, that's where we're shifting from kind of the current correlation in black towards more positive correlations. And what you'll see is, regardless of the risk profile, that implies that you would need to shift a little bit more into fixed income in order to maintain that same level of risk. You'll also note that the impact of correlation change is larger for more defensive profiles, implying a meaningful shift towards fixed income when those correlations are positive. Now, another thing to consider in your portfolio construction process is the role of scenario analysis. So not just thinking about risk, I guess, in normal market conditions, but also stressing portfolios in very much abnormal market conditions, looking back historically and thinking about the hypothetical P&L impact that a given portfolio would show in those historical scenarios. So that's what we're looking at here. And to sort of better account for these changing relationships between equities and bonds, we think it's important to leverage these types of stress test scenarios, but also to look at these in the context of different historical correlation regimes. And we've got 2 examples of those here. So these are those same 5, 7.5 and 12% portfolios that we saw on the previous slide, but looking at the P&L impact of those portfolios were they to go through these historical scenarios. So the first looks back to the market shocks witnessed in 1974 during a stagflationary environment. So obviously, the stag element is stagnating economic growth, stagflationary, the inflation piece being very high. On the right-hand side, we see the 2008 recession, obviously a little bit fresher in people's memory than 1974, perhaps. But what we witnessed during those 2 periods is that correlations between equity and bonds were at very different levels. And you see that from the portfolio impact here. So on the left-hand side, in terms of the 1974 scenario, the correlation between equities and bonds was around 0.4, whereas in 2008, there was negative correlation of minus 0.1 during the recession. Now, in the stagflation scenario on the left, we observe the 5% risk portfolio selling off by around half that of the 7.5% portfolio. However, in the 2008 risk scenario, the drawdown of the most cautious portfolio is, notably low relative to that of the more balanced or more aggressive model. And I guess what that's showing, that kind of larger disparity of outcomes between lower risk portfolios and higher risk portfolios, was driven by the fact that during 2008 there was that more negative correlation from fixed income. So you're getting a wider dispersion of outcomes because fixed income is performing the role that you'd like it to in terms of portfolio ballast. Whereas in the stagflation scenario, yes, in terms of magnitude, maybe the drawdowns are lower, but what you'll see is there's actually a much tighter dispersion in terms of the outcomes that lower risk versus higher risk portfolios saw because of that more positive correlation during that period. So running these sorts of portfolio analyses can help to provide a little bit more of a holistic picture of how the portfolio might perform in more extreme market events, and supports investment managers to kind of think about quickly reacting and repositioning portfolios should such changes to the correlation environment occur. Now, what sort of changes might those be? Might those imply? And I think one example of that is the approach that you take at a high level in terms of your asset allocation approach, whether that is more dynamic as a function of having a more risk-targeted approach to your portfolio construction, or whether your starting point is a more static asset allocation. And that's kind of what we see on this top chart. The kind of top two charts are an illustration of your static portfolio allocations, resulting in obviously a lot more variability in portfolio volatility. Whereas underneath, if you're taking more a volatility targeted approach, your aim is obviously to target a roughly equal level of volatility over time. But what that will necessitate from a portfolio construction perspective is the evolution of your asset allocation. And here, for simplicity, we're just thinking about equity and fixed income. But what you can observe there illustratively is that clearly you're going to be needing to evolve your equity bond split over time in order to maintain that level of risk. So our thesis for kind of long-term success and stability from a strategic asset allocation perspective is that this dynamic asset allocation has got to come to the fore of the investment process, and that be underpinned obviously by rigorous risk management. We think that this sort of profound shift in paradigm should promote a kind of rethink of the investment process. And in our view, the sort of portfolios that may follow this kind of simple set and forget static asset allocation approach are based on slightly outdated portfolio construction approaches, and may not necessarily deliver the consistency of outcome, whether that's across risk or return, that many of us expect from these strategies. So to Mandeep's point, in terms of as we're moving out of this great moderation period, you should expect of your multi-asset managers a more dynamic approach to asset allocation, and those be informed by more frequent adjustments to asset allocation. And that can be implemented in an ideal world through investment vehicles which provide the liquidity to be nimble across different market conditions. Now, one way that you can think about approaching that is blending together different approaches to multi-asset investing. And what we see on the left-hand side here is a few kind of illustrative example approaches that you might consider. So initially, you might be thinking about that risk-targeted approach that we mentioned, i.e. you're targeting 5%, 7.5%, 12%, whatever it might be, but that comes with it changes in asset allocation in order to deliver that. On the flip side, you might be thinking about more of a static allocation approach, your kind of classic 60-40 set and forget. Obviously brings with it quite a lot of simplicity in terms of messaging to end clients, but potentially not necessarily the same rigor in terms of outcome from a risk perspective. Then you might have the sort of more flexible approach in terms of looking at an active multi-manager, i.e. still a fund-of-fund structure, but potentially the manager leveraging active or alpha-seeking managers in order to deliver that outcome. Obviously there, you've got the potential of delivering alpha, not just at the asset allocation level, but also at the manager selection level. And then finally, you might have your own in-house MPS or in-house CIP, where you're obviously selecting your own underlying managers. That obviously brings with it complete flexibility, but obviously a little bit more kind of risk, I guess, in the business risk sense of things, in that is on you in terms of maintaining the level of risk of those portfolios and ensuring that they're delivering the outcomes that your end clients would be looking for. So a few kind of illustrative examples. If you go for sort of one approach versus another. What we've actually been seeing is that in a lot of cases, we see clients thinking about blending these different options together. So the two pie charts at the bottom, just kind of illustrative blends of what that might look like, depending on what your focus might be. But I think the key point to mention is that, whilst each of these have merits in isolation, there's also a lot of sort of potential arguments for blending these together, depending on the outcome that you're looking to seek. So some reasons on the right-hand side there that you might want to consider the blending of these different types of multi-asset strategies. So the first is kind of diversification, fairly obvious point. Obviously, if you're taking different approaches, that will bring with it variations in performance driven by different risk profiles over time. The second could be on the cost reduction side of things. So if maybe your focus is a little bit more on the active multi-manager side, or maybe on running your own in-house MPS, where you've got a higher allocation to alpha seeking and therefore typically higher fee underlying managers, potentially blending with some of those kind of lower cost, whether that's risk targeted or static allocation managers, could lead to cost reduction at a sort of whole proposition level. There's also then the benefit potentially of combining these different portfolio construction approaches, and the fact that that could lead to risk mitigation in different market regimes. So we sort of saw an example of that, obviously, in the rate, the sort of very sharp rise in rate expectations feeding through into drawdowns in particularly, benchmark and longer duration fixed income allocations. And if you did have maybe more of that static allocation approach, then it could well have been that your cautious portfolios were hit particularly hard as a function of that. And maybe if you were taking more of a risk targeted approach, where maybe you would either have dialed down your fixed income allocations or indeed thought about the allocations that you do have tilting a little bit more into shorter durations, then maybe that risk targeted approach would have led to some sort of risk mitigation and maybe smaller drawdowns in those more savage market regimes that we saw throughout kind of 2021 and also at the start of this year as well. You can also think about dialing up and down your home bias. So different managers might have different views in terms of the degree to which they'll be tilting to their home markets. Obviously, it's something that we see very prevalent in the UK market. Investors often want to have a bit of a tilt to the UK, whether that's on the equity side or the fixed income side. But some managers will do that to a greater or lesser degree than others. So again, you can sort of think about your blends of these different multi-asset strategies in order to express your view of your home bias, and that also be still within that risk targeted and risk aware framework. And then I think the last couple of points in terms of flexibility meeting risk awareness. Obviously, if you're maybe looking at the active multi-manager side or your own in-house MPS, there's an implication there that those strategies are a little bit more nimble. You've got a bit more flexibility there in order to potentially achieve some active return for your end clients. But as I said, maybe there's a little bit more active risk that you're needing to take to do that. So you can trade off the fact that you do get that flexibility and potentially higher alpha from those types of strategies by blending together the more kind of risk aware, risk targeted, or indeed the sort of maybe sort of simpler messaging that you get from static allocation. But I think the final point is maybe a little bit more of a qualitative one, that in terms of your messaging to end clients when you're thinking about constructing your CIP, actually in terms of ensuring that, I guess, you're building a moat around your business and the value add that you provide to clients, blending together different multi-asset strategies obviously requires a degree of expertise that those end clients would almost certainly be lacking on their side. And they might be forgiven for thinking that if they were proposed, a single line as their investment solution, why can't I go and do this myself? And that might raise the question in their minds a little bit. And what we've maybe heard is that actually the act of blending these different strategies together in a way sort of cements the value add that you're offering to your clients and ensures that they don't get the misled impression that they can go away and run their own investments without your expertise. So sort of linking some of those concepts of blending together these different asset allocation approaches sort of back to how we think about asset allocation evolving over time. The sort of new and more agile investment process that needs to be driven by this great moderation being over leads to likely the triggering of the incorporation of new asset classes and also perhaps higher portfolio turnover than many end investors might be used to. So here we see an example of that in the context of a BlackRock model portfolio managed using risk targeting. So what this hopefully highlights is how much the portfolio management team have had to evolve their asset allocation mix over, in this case, it's the last 5 years, in order to maintain the risk target of, in this case, 7.5% for the sort of moderate risk profile. So you obviously see it's far from a kind of set and forget static allocation. You're needing to see over time evolution in terms of that asset allocation in order to seek to deliver that consistent risk target as the the key outcome for why clients generally choose to invest in these sort of risk profile multi-asset portfolios. One thing that also needs considering is FX risk or currency risk. So typically, obviously, we've been discussing asset allocation in the context of equity, fixed income, your more traditional asset classes. But I guess in the background, there's this kind of ghost asset class that people maybe don't necessarily give as much thought to as potentially they should, as implied by how much risk FX can drive in a multi-asset context. And this chart is something that illustrates that. So what we're seeing here is the decomposition of risk over time of a global 60-40 portfolio, unhedged from the perspective of a sterling investor. And whilst obviously in yellow, we're seeing large proportion of portfolio risk driven by equities, you've got a little sliver of rates and spreads risk coming from your fixed income allocations. But one thing that definitely jumps out is the sort of pink risk contribution that we're getting coming from equities, as much as 40+% at its peak around sort of 2017, 2018 in this sample. But I think what it shows is that in addition to needing to make active dynamic asset allocation decisions on things like equity and fixed income, FX also needs to play a role there, and that currency risk warrants being actively managed in the same way and considered during that portfolio construction process. So I think with that, I'll hand back to Mandy to close us out. But oh yeah, I guess we jumped. I think we jumped. Oh, okay. No. That's fine. I guess yeah. Maybe you can sort of touch on this piece in terms of the cost effectiveness side of things. I think then there are also other areas in terms of sort of net zero and sustainability, which I guess we can potentially touch on. But maybe Mandy, I could sort of hand over to you in terms of the importance of cost effectiveness, also in terms of how you're thinking about that asset allocation approach, and that just because maybe the asset allocation approach is something that you agree with, actually if you're getting the erosion of some of that sort of great work that's being done by the investment manager through higher costs, then that's something which is potentially a cause for concern. But
absolutely. Well, thank you very much, Ben. That's been incredibly useful. And just to touch upon one last point, the blending multi-asset piece there is something which we actually have a study on that Ben kindly produced, which has been landing very well with advisors up and down the country. Yeah, so a lot of work's gone on into that. But what I'll do is I'll come back to just the cost-effective piece, right? And because I'm quite conscious of time as well, and maybe leave a minute or so for questions too. But look, throughout the last 40 minutes, let's say, we painted quite the stormy picture, and you might be on the other side of the screen now asking, what now? Where can I find a managed solution that can navigate me through this period? And the good news is that we here at BlackRock strongly believe we have an appropriate solution to support and navigate your way through this new regime, the MyMap fund range. So there's actually a really nice and compelling story behind the launch of our multi-asset solution. Now, when you hear BlackRock, I know certainly this was me a few years ago, you immediately think large institutional investor, which we are. The largest asset manager in the world, which was only founded in 1988. And when you take a moment to look at, let's say, for example, the tenure of your other asset managers, largest asset managers below us, they were all founded in the 70s, 50s, and in some cases before the 40s. So the rise really has been extraordinary. However, around 5 years ago, BlackRock made a conscious decision to start using our massive resource to begin to start to support advisors up and down the country in the UK, because it's an area which we haven't necessarily explored, but it's something we genuinely believe that it's an area we genuinely believe that we can help and support, particularly going forward. And the key component of this, of our introduction into the advisor market, was the introduction of the MyMap fund range, launched a little under 4 years ago. I think we might just be about 2-3 weeks off our 4-year anniversary. But in short, the range of multi-asset funds consists of four core funds, 3 ESG funds consisting of equity, fixed income and alternative funds, providing you and your clients with a simple yet diversified and risk managed solution. Now, this range, MyMap range, consists all of underlying iShare funds, giving you and your clients exposure to some of the most high quality and sophisticated funds in the market today. Now, there is a tactical overlay of these underlying passive funds, which means we are able to tailor and adjust certain exposures to adapt to an ever-changing market environment, something we're in at the moment, but something not all of our competitors can do. And finally, we utilize a system called Aladdin, and I'm not referring to the Disney character. It's a state-of-the-art risk and forecasting technology tool, which was founded on day one of BlackRock's launch. So that's implemented into the investment philosophy of the fund range. So essentially, you and your clients have all of this institutional exposure to retail clients for 17 basis points, 0.17%, one of the most cost-effective solutions on the market today. And here's a really interesting side. And what we can see here is the performance of the core funds, MyMap 3, 4, 5, and 6, against competitors in the market since the fund's inception. The annualized return is on the y-axis, and standard deviation is on the x-axis at the bottom. Now, you know, whilst the fund range's performance is quite impressive, it's top quartile since inception, I don't want to spend too much time talking about the performance in itself. What's interesting about the range is that quite often it's compared to the mixed IA investment sector when measuring performance. So looking at your more traditional competitors against multi-assets, and you can see its performance is, you know, performed well, as I mentioned. But what's interesting and what it should be measured actually against is the volatility managed sector. And recall Ben's slide when we saw, you know, the volatility multi-asset solution versus something a bit more strategic. And I want to draw your attention to the bottom there. And what we can see there is the volatility bands of each one of the funds. So you can see MyMap 3 there, its volatility band is 3 to 6, MyMap 4 is 6 to 9, and so forth. And as previously stated, you know, this is a risk managed solution. So it's very important that we stay within the bands for which it has all of the solutions. But just drawing your eyes to 3, 4, and 5, they've not only stayed within the bands, but they've been towards the end, suggesting it's capturing the upside without taking any undue risk. So very conscious of time once again. So I'll finish on a very, probably one of the best slides of the presentation, the UK advisor coverage team. I'm supported by a great couple of colleagues here, Ed and David. As you can see there, I cover the north of England and Scotland. Ed covers London, Midlands and Northern Ireland, and David covers the south of England and Wales. Obviously, this presentation and our details will be distributed to you shortly after the call. However, if you cannot wait to talk about MyMap, my number is there and I am free for the next 45 minutes after this presentation, but we'll see how that gets on. But that draws us to the end of the presentation. And I guess I can hand over to see if there's any questions.
Yeah, thank you very much. Yeah, that was fascinating stuff. And I mean, yes, it's definitely one of the key conversations that we're having at our side when we're discussing centralized investment propositions. It's kind of like going into more detail about what a multi-asset strategy is offering, and whether it's like, you know, a strategic asset allocation, whether it's like those fixed equity bond allocations, or whether it's a little bit more dynamic and a little bit more, you know, as you say, like risk targeted rather than asset targeted. And yeah, it's definitely something that's more and more advisors are considering as part of their centralized investment propositions. But yeah, so if there's no further questions, so we haven't had any in the chat, so I'm assuming PC had his little the regime definition cleared up. But
Other than that, if you feel free to submit any further questions via the chat, then we'll address them now. Or if you would prefer, then you can just submit them as part of the feedback forms, and then they will find their way to Mandeep. Or if you would like to contact any of the advisors through, or any of the BDMs through BlackRock, then their telephone numbers are just there, and will also be distributed on the slides following today's event. So yeah, as I said, I don't think there's any more questions coming through. So we will sorry, Peter's just expanded on it. So during the presentation, so he's asked for a definition of regime. So I think it was, I can't remember which slide it was when it came through. But yeah, it was just the definition of a regime, and presuming it's a reference to changes from QE to QT.
Yes, so I guess the way that we think about that is this sort of period of economic support provided by central banks, initially obviously in the form of rate cuts, and then to kind of Mandeep's quote that he gave from the Bank of England back when QE began, there's only so far you can cut rates down to zero or the effective lower bound, as we saw in euros. That went lower than that, and then in order to be accommodative in a further sense, that then requires a different monetary policy toolkit. So that was QE. Then obviously, as economic conditions changed and as the inflationary picture picked up, then clearly there was a need to move further towards a hiking interest rate cycle already off the back of kind of QT. So in our view, it was sort of as we got to really the start of kind of 2020, really, when we then kind of saw this sort of change in regime and what I guess we would term the Great Moderation as being over. So this Great Moderation as being a period of easy monetary policy in a backdrop of low macro and market volatility when you look over sort of fairly long horizons. In our view, that period is over, and that brings with it much more volatility from a macro and therefore markets perspective, which is the logic behind that feeding through into the necessity for multi-asset portfolios to be not only more granular in the exposures they're thinking about using, but also being more dynamic and reviewing their asset allocation more regularly in light of the market backdrop being that much more volatile and that much more changeable in this new regime, as opposed to the Great Moderation that came before it.
Top stuff. Yeah, Pete says thanks for the explanation. Okay, well, I guess that wraps up today's event. So we'll be sending out some feedback forms. So it'd be great if you could fill those out. So it's always great to have feedback, good feedback, constructive criticism on how these events should be going forwards. It's always very useful to have on hand with any further questions or further topics you'd like to see covered. But then, other than that, I'll say thank you very much on behalf of Verve, and thank you very much for attending today's session, and we hope to see you all again very soon.